For over 2 decades, the IRS has curated a comprehensive list known as the Dirty Dozen, aimed at highlighting the most prevalent tax scams and tricks. Despite its catchy name, this compilation serves a crucial purpose, offering valuable insights for taxpayers, tax preparers, and financial advisors alike. The Dirty Dozen isn't just another bureaucratic document, it's a practical tool designed to arm taxpayers with knowledge to safely navigate the complexities of tax season. By providing real-world examples and detailed insights, this list offers a proactive approach to identifying and avoiding potential tax traps and scams. Imagine diligently filing your taxes only to unknowingly fall victim to a phishing email claiming to be from the IRS or being misled by a fraudulent tax preparer promising inflated refunds. Without awareness of these common schemes, anyone could become a target. That's where the Dirty Dozen list comes in. It empowers taxpayers to recognize red flags and protect themselves against fraudsters. Whether you're a seasoned taxpayer or new to the process, consulting the Dirty Dozen list annually is essential. It's not merely paperwork. It's a vital resource that can save you from headaches, audits, and financial losses. Consider it a friendly heads-up from the IRS, helping you safeguard your hard-earned money and navigate tax season with confidence. In this video, we'll discuss the significance of the IRS Dirty Dozens list, exploring how it serves as a crucial resource in protecting taxpayers from common tax scams and pitfalls. The 2023 Dirty Dozen list from the IRS includes various tax scams and schemes to watch out for. These include false claims for the employee retention credit, phishing and smishing attempts, fake charities, seeking personal information, and unscrupulous tax return preparers. Other scams involve fraudulent form filing on social media, spear phishing attacks on tax professionals, and misleading offers like the offer in compromise mills. High-income filers are targeted with schemes like CRAT misuse and monetized installment sales, while bogus tax avoidance strategies involve micro-captive insurance arrangements and syndicated conservation easements. International elements include offshore accounts, Maltese individual retirement arrangements, and Puerto Rican and foreign captive insurance. It's crucial to stay vigilant and informed to avoid falling victim to these scams and protect your financial well-being. Every year, the IRS updates its Dirty Dozen list with new scams and schemes while keeping some old ones that continue to pose a threat. In 2023, some of the new additions include fraudulent employee retention credit claims, bad social media advice, online account help from third-party scammers, false fuel credit scams, and unscrupulous tax preparers. Interestingly, the 2022 Dirty Dozen list had items like pandemic-related scams, unemployment fraud, fake employment offers in social media, and high-income individuals not filing, but these were dropped in 2023. However, just because they're not on the list doesn't mean the IRS isn't aware of them. The list can only hold so many items, and some rotate on and off over the years. You can check out past Dirty Dozen lists dating back to 2014 on the IRS website for more insights and awareness. Some items on the Dirty Dozen list are straight-up scams, like identified theft or bogus charities, but there are also tax credits and deductions such as conservation easements that can be legit but are often abused according to the IRS. These can raise red flags and lead to intense IRS scrutiny and enforcement actions against those who claim them or promote them. Take syndicated conservation easements, for instance. The IRS has audited tons of shady deals related to these. When a new item shows up on the Dirty Dozen list, especially if it's right at the top, you can bet the IRS is really focused on it. Case in point, the Employee Retention Credit (ERC) only made the list in 2023 and it got top billing. This signals that the IRS is going all in to combat fraudulent ERC claims. Now that doesn't mean you shouldn't claim the ERC if you qualify. Just make sure you've got all your ducks in a row with proper documentation in case the IRS comes knocking for an audit. It's about saving legit while navigating these tricky tax waters. The IRS urges the public to report abusive schemes on the Dirty Dozen list as part of its efforts to raise awareness about tax scams. The IRS encourages the public to report individuals promoting improper or abusive tax schemes as well as tax preparers who unknowingly file improper returns. To facilitate this, the IRS has introduced Form 14242, designed specifically for reporting suspected abusive tax promotions or preparers. Reports made through this form can lead to various actions against the offenders. These actions may include injunctions against abusive tax promoters or preparers, monetary penalties, suspension or revocation of electronic filing identification numbers, criminal prosecution, and referral to the Office of Professional Responsibility. To bolster its efforts, the IRS established the Office of Promoter Investigations in 2021. This office is dedicated to identifying and stopping promoters and enablers of abusive tax avoidance transactions. Apart from promoting the Dirty Dozen list and encouraging leads from taxpayers, the IRS intends to utilize new technology and data analytics to detect and combat sophisticated evasion techniques promptly. This approach aims to facilitate timely audits and collection investigations to ensure tax compliance and deter fraudulent activities. Taxpayers involved in reportable transactions are required to disclose them to the IRS using Form 8886, Reportable Transaction Disclosure Statement. For listed transaction, the penalty can be up to $200,000, $100,000 for individuals, while for reportable transactions it can be up to $50,000, $10,000 for individuals. Material advisors who promote or assist in these transactions must also disclose them using Form 8918, Material Advisor Disclosure Statement. The penalties for non-disclosure vary, with transactions for interest carrying a penalty of $50,000 and listed transactions having penalties up to $200,000 or 50% of the advisor's gross income from the transaction, whichever is greater. These penalties are imposed in addition to any other penalties assessed by the IRS. Employing a tax strategy or scheme listed on the Dirty Dozen not only increases the likelihood of an audit but can also lead to significant tax penalties if the IRS determines that taxes were underpaid due to the use of such strategies. These penalties apply to taxpayers, tax preparers, and promoters alike. Penalties for preparers can change from $1,000 or 50% of the derived income up to $500,000 or 75% for willful or reckless conduct. Viewers, every year the IRS puts out its Dirty Dozen list, shining a spotlight on shady tax schemes and dodgy practices. Some of these are flat out fraudulent, while others might seem legit but are often twisted by taxpayers over their benefit. If you're on that list, expect the IRS to have a magnifying glass over your tax strategy. They even have forms for folks to report anything pushing these sketchy schemes. Guys, if your tax strategy is on that list and the IRS catches you underpaying taxes because of it, you could be looking at some hefty penalties. It's like a warning sign saying proceed with caution, so always be careful with the tax strategies of the Dirty Dozen. They could end up costing you big time if the IRS comes knocking. Subscribe for more tips and insights on navigating the world of taxes and finances.